So, picture a sprawling expanse out in West Texas. Like, it's late December, right?
Oh yeah, freezing cold out there.
Exactly. The wind is howling, the temperature's dropping toward freezing, and sitting on a patch of dirt that's like the size of a football field is a pressure pumping fleet.
Right, and we are talking about tens of millions of dollars of massive roaring machinery.
Yeah, giant diesel engines, high pressure pumps, silos of sand, chemical mixers. I mean, it's an operation that looks way more like a military forward operating base than, a standard business.
It really does. It's massive.
And now imagine the executives who own all that equipment.
Okay.
They're looking at the current market, they're looking at the spot price of oil, and they're making a conscious, deliberate choice to just turn the keys and shut it all off.
Which is wild.
Right. They just park the fleet, they send the crews home. Like, they choose to make literally $0 on that equipment rather than put it to work.
Which, it runs completely counter to everything we're taught about capital-intensive businesses. You are supposed to keep the assets running to cover your fixed costs. So the idea of voluntarily parking a highly expensive, depreciating asset just because you don't like the spot market pricing, that is a massive flex of financial endurance.
And that flex, that ability to just say no to bad work, is exactly why we are looking at this specific company today.
Yep.
So welcome, everyone, to another earnings deep dive. Our mission here is to cut through all that Wall Street jargon, pull the most critical data from these really dense corporate earnings transcripts, and, figure out what it actually means for you, the retail investor.
Because there's a lot hiding in those numbers.
Oh, absolutely.
Yeah.
So today we are going to look at the physical reality of the oil field, the accounting mechanics that kind of hide the real numbers, and the psychology of a management team that is just, sitting on a mountain of cash.
Right. And today's focus is RPC Inc. They trade under the ticker symbol RES.
RES, got it.
Yeah. They are a pretty significant player in the oilfield services space, and today we are unpacking their fourth quarter 2025 results.
Right.
But we really need to set the stage carefully here because the environment they are operating in right now is incredibly choppy.
Yeah, it's rough out there.
It is. The energy markets are dealing with low commodity pricing, unpredictable and severe weather impacts, and this rapid, almost violent shift in completion technology out in the field.
Yeah, and when we say oilfield services or OFS, we should probably clarify what that actually means for anyone listening who might be new to the sector.
Good idea.
Because, the exploration and production companies, the EMPs, so companies like Exxon or Pioneer, they own the lease, right? And they own the oil.
Right.
But they don't necessarily own the trucks or the pumps or the specific tools that actually crack the rock and get the oil out of the ground.
Exactly. They outsource all that heavy lifting.
Yeah. And that is where companies like RPC come in. They are the muscle. They provide the pressure pumping, the wire lines, the specialized downhole tools.
So they're the ones in the dirt.
Right. So when the energy market sneezes, it's usually the OFS companies that catch a cold. And we are going to see exactly how RPC is navigating a very volatile market right now.
It's definitely a tricky time.
Okay, let's unpack this. I want to jump straight into the top line financials, mostly because, at first glance, the numbers look a little grim.
Yeah, they certainly paint a picture of a contracting quarter for sure.
Right.
So for Q4 2025, RPC reported revenues of $426 million.
Which is a 5% drop sequentially.
Right.
Meaning, for you listening, compared to the third quarter of 2025, their revenue actually shrank by 5%.
Yeah.
And that contraction, it trickled all the way down the income statement. Like their adjusted EBITDA, which is basically their cash profit from operations before you account for interest, taxes, depreciation, and all that, it came in at $55.1 million.
Which is down.
Down significantly from the $67.8 million they posted in Q3.
Yeah, the drop in EBITDA is one thing, but the margin compression is what usually gives investors heartburn.
Oh, absolutely.
Their EBITDA margin shrank by 230 basis points, landing at 12.9%.
Okay, wait, let me stop you right there. Because basis points is one of those classic Wall Street terms designed to make finance sound like some kind of secret society.
Fair point, fair point.
For everyone listening, 230 basis points just means 2.3%.
Right.
But I really don't want to gloss over that. I mean, a 2.3% drop in profit margin in a single quarter, that is not a rounding error.
No, not at all. It's a very real hit. I mean, in a capital-intensive business like oil field services, your fixed costs, maintaining facilities, keeping your core staff, servicing the equipment, they just don't disappear because revenue drops 5%.
The bills still come due.
Exactly.
Yeah.
So when your top line shrinks, a larger percentage of every dollar coming in has to go toward those fixed costs, and that just squeezes the margin at the bottom.
Makes sense.
So going from over 15% to 12.9% EBITDA margin, it basically means they are working almost as hard, but keeping noticeably less of the cash.
Yeah, which that brings us to honestly the most chaotic number in this entire earnings report, which is the EPS, or earnings per share.
Oh, yeah. This one is messy.
It's so messy. The adjusted diluted EPS came in at 4 cents, just 4 cents a share.
Right.
Like if you are a retail investor and you just have a stock app on your phone, right? You get a push alert that says RPC posts 4-cent EPS, and you probably assume the business just completely fell off a cliff.
You'd think they were going bankrupt.
Right. But the transcript tells a completely different story.
Okay.
The CFO, Mike Schmidt, he detailed that buried inside that. 4 cents are actually 6 cents worth of what management calls adjustments.
Air quotes around adjustment.
Yeah, exactly. And I want to spend some time here because this is where algorithmic news alerts fail completely. Like, what were these massive hits that skewed the EPS so badly?
Well, there were two major components to that 6-cent adjustment, and honestly, neither of them indicates a failure in their actual ability to service oil wells. So the first one is a purely financial restructuring move. RPC experienced this unusually high tax rate in the fourth quarter because they liquidated company-owned life insurance policies.
Okay, I have to push back on this because that sounds completely absurd on its face.
I know it does.
Why does an oil field services company, whose actual job is to pump sand and water into the dirt, why do they own life insurance policies? Like, are they moonlighting as an insurance broker?
It sounds super strange, I know, but it's actually a very common, albeit pretty complex, corporate finance tool.
Really?
Yeah. It's called COLI, corporate-owned life insurance.
COLI. Yeah.
Companies often use these highly specialized policies to fund non-qualified supplemental retirement income plans for, their executives or highly compensated key employees.
Oh. So it's basically like a shadow 401k for the higher-ups.
Yeah, that's actually a really reasonable way to look at it because, the IRS limits how much you can put into a standard 401k.
Right. There's a cap.
So for executives making significant salaries, companies set up these non-qualified deferred compensation plans to offer them, additional retirement benefits.
Yeah.
And to fund those future liabilities, because the company will eventually have to pay those executives that money, the company buys life insurance policies on the employees.
Wait, they buy policies on their own employees?
Yep. They pay the premiums, and the company acts as the beneficiary. The cash value of these policies grows tax-deferred, and the company uses that growth to eventually pay out the retirement benefits.
Wow. Okay, so they basically use the tax-advantaged shell of a life insurance policy as like an investment vehicle to cover future retirement obligations.
Precisely. It's sitting there as an asset on their balance sheet. But in this specific quarter, RPC's management decided to just dissolve this specific non-qualified retirement plan.
Okay.
And to do that, they had to liquidate the underlying life insurance policies and cash out the related investments.
Oh, I see where this is going. And when you cash out an investment that has been growing tax deferred for years, the IRS suddenly shows up with their hand out.
Exactly. Cashing out those policies triggered a significant immediate increase in their tax expense related to the taxable gains on the sale.
Got it.
So a huge chunk of cash goes out the door to the government, which drags down the net income, which in turn artificially tanks the earnings per share for this specific 90-day period.
Okay, that makes perfect sense, but it is completely disconnected from how many wells they actually fracked in December. It's just a balance sheet clean it.
Exactly, just paper shuffling mostly.
But you mentioned there were two components to the 6-cent adjustment. What was the second hit?
Right. So the second part comes from operational and accounting changes. There was some minor acquisition-related employment costs, specifically non-deductible portions of SG&A or selling general and administrative expenses.
Right.
But the much larger and honestly far more interesting component was a sudden change in how they account for a very specific piece of equipment, their wireline cables.
Ah, okay. This is where the accounting actually intersects with the physical reality of the oil field.
Yes.
Because they previously capitalized these cables.
Right.
And then suddenly they decided to expense them immediately.
Yep. They took cables that were sitting as assets on the balance sheet from previous quarters and just ran the remaining cost straight through the income statement as an immediate expense.
Man. I was trying to figure out how to visualize this earnings report for someone who doesn't live and breathe corporate accounting, because taking all these hits at once, it just makes the financials look terrible.
It looks awful.
It's like looking at a friend's bank statement, right?
Yeah.
You check their balance and it looks like they're going completely broke. The account is drained.
Right.
But then you audit the transactions and you realize, wait, they just paid off a massive lingering medical bill and they bought a brand new truck in cash on the exact same day.
Great analogy.
Yeah. Like the underlying earning power, their actual weekly paycheck is still exactly the same. It's just being masked by these massive simultaneous cash events.
That analogy holds up perfectly. I mean, the life insurance liquidation is the medical bill. It's a necessary one-time cleanup of an old liability.
Right.
And the wireline accounting change, that's buying the truck in cash. When you buy a truck in cash, your bank account drops instantly, sure, but you now own a truck that provides value for years.
Exactly.
The money didn't just disappear, it was converted into an asset. Or in the case of the accounting change, the recognition of the cost was just pulled forward. The underlying health of the business is so much stronger than that 4-cent EPS headline suggests.
But, and this is where we need to pivot a bit, we can't just, wave a magic wand, blame the accountants, and pretend it was a flawless quarter.
True.
Because even if we back out the 6 cents of adjustments, that 5% drop in top-line revenue down to $426 million, that is a fundamental business reality.
Yes, it is.
They bill their customers less money. So we have to figure out what actually happened out in the dirt to cause that.
And to understand that, we really have to look at the timeline of the quarter. CEO Ben Palmer laid out exactly how the 3 months progressed, and it was a very distinct tale of two halves.
Okay.
October and November were solid. Management noted that activity levels were essentially consistent with the run rate they saw in the third quarter.
So the E&P companies were still working, they were still drilling, still calling RPC to come out and finish the wells.
Yes, they were busy. But then December arrived and the bottom just fell out.
Oh, wow.
Yeah, they saw significant weakness, particularly in the back half of the month.
I'm going to break down exactly where that weakness came from because, RPC is not a monolith, right? They have multiple different service lines.
Right. They have a lot of different pieces.
Yeah. And they broadly categorize them into technical services, which make up about 95% of their total revenues, and then support services, which make up the remaining 5%. So we really need to look closely at the big three technical service lines to see where the bleeding actually happened.
Let's start with their absolute largest segment then, pressure pumping.
Okay, this is the heavyweight division. Pressure pumping makes up 27% of their total revenue.
Yep.
And for the listener who might not be totally familiar, pressure pumping is essentially the core of the hydraulic fracturing or fracking process.
Right.
RPC brings in these massive trucks equipped with just high horsepower pumps, and they blast a mixture of water, sand, and chemicals thousands of feet down into a wellbore at immense pressure.
The scale is unbelievable.
It is. And the goal is to literally crack the solid shale rock open so the oil and gas can flow out. It requires an insane amount of horsepower, and frankly, it is brutal on the equipment.
Very brutal.
But in Q4, revenue from this specific segment fell 6% sequentially. Why did the largest piece of their business shrink?
Well, there were two primary drivers for that. The first is somewhat seasonal, honestly. It's holiday shutdowns.
Oh, like Christmas and stuff.
Exactly. The E&P companies, their customers, they often slow down or just completely pause their completion operations around Thanksgiving, Christmas, and New Year's.
Because nobody wants to work the holidays.
Right, and they definitely don't want to pay holiday rates for crews. Plus, they often try to manage their capital budgets as the year closes out. So a December slowdown isn't entirely unusual.
Okay, but you said there were two reasons. The second reason wasn't seasonal, right? That was entirely within RPC's control.
Yes.
Goes back to that scenario we opened the deep dive with. They actively, intentionally decided to idle a pressure pumping fleet in October.
They did, and this is just a fascinating look into management's psychology and their view of capital discipline.
Oh, so?
Well, they didn't park that equipment because it was broken, or because they couldn't find a crew to run it.
Right.
They parked it because they ran the math on the spot market pricing being offered by the E&P companies, and they decided the juice just wasn't worth the squeeze.
Meaning the E&Ps were demanding discounts, and RPC just said, no thanks. I find this dynamic so interesting because, like we said, pressure pumping equipment destroys itself by design.
It really does.
When you are pumping abrasive sand at like 10,000 PSI, you are literally chewing up the fluid ends of your pumps. You are blowing out valves. You are just degrading the engines. The maintenance costs are astronomical.
Exactly. Every single hour that fleet is running, it is depreciating and parts are actively wearing out.
Right.
So RPC's management looked at the low prices being offered and realized that, hey, if they accepted that work, the revenue they brought in might barely even cover the maintenance and replacement costs of the equipment they were destroying in the process.
Wow. So it's basically a zero-sum game at that point.
Totally zero sum. You are trading your machinery for cash just to hand that cash right back to the part supplier.
That has no sense.
Right. So they made the disciplined, albeit pretty painful for top-line revenue, choice to just idle the fleet and preserve the equipment for when pricing actually improves.
I respect the discipline. I really do. Even if Wall Street hates the revenue drop. But let's move to the second biggest segment, which is wireline.
Okay.
This makes up 24.1% of their revenue, and it was down 3%.
Yeah.
But let's define what a wireline actually is for the listener before we talk about why it dropped.
Sure. So a wireline operation involves lowering equipment or measurement devices down into the wellbore on a continuous armored electrical cable.
Okay, picture that.
Right. So think of a well that has been drilled 3 miles straight down and then turns horizontally for another 2 miles.
That's a long way.
It is. You need to get sensors down there to read the pressure, or you need to lower perforating guns, which are essentially explosives used to blast holes in the steel casing and the rock before the pressure pumpers even come in.
Okay, so the wireline is the tether for all that.
Exactly. But the wireline is the physical tether and the communication link for all of that crucial work.
And RPC is the largest wireline provider in the Permian Basin in West Texas and New Mexico, right? Which is arguably the most important oil field in the world right now.
Absolutely. And because of that massive market share, RTC's wireline business is highly correlated with the overall activity of the large Permian operators.
I see.
So when those big E&P companies pull back their budgets in December for the holidays, RPC's wireline division feels it immediately. It's just a direct reflection of overall basin activity.
Okay, so pressure pumping was down 6%, mostly by choice, and wireline was down 3% due to basin-wide slowdowns.
Yep.
That brings us to the third big piece, downhole tools. RPC operates this segment largely through a brand called Through Tubing Solutions, or TTS.
Right.
This is 22.4% of their revenue, and this segment actually saw the steepest drop of the big three. It was down 9% sequentially.
Yeah, that was a big hit. But this drop was highly localized. It wasn't some broad failure of the tools themselves.
Oh, really?
No. In fact, they noted growth in their southeast and northeast operating regions. And even their largest domestic region, the Western Mid-Continent, which includes major hubs like Elk City and Minco over in Oklahoma, that remained totally flat.
Okay, so if the domestic side was mostly stable or growing, where did the 9% drop come from?
The weakness was almost entirely driven by international markets, specifically the Middle East, and then domestically, a really sharp drop-off in the Rocky Mountain region.
Oh, gotcha. Well, let's tie this all together because during the Q&A portion of the earnings call, an analyst named Derek Podheiser from Piper Sandler started probing into a specific issue that kind of bridges these operational segments with the accounting weirdness we talked about earlier.
Yeah, he asked about the wireline cables.
Right.
And this is where the transcript gets incredibly insightful. Like, it connects a very dry accounting policy to the brutal physical reality of modern oil extraction.
Yeah, because as we mentioned, RPC decided to start expensing these wireline cables immediately upon purchase, rather than capitalizing them and depreciating them over 18 months.
Yep.
Now, to you, a retail investor, the debate between capitalizing versus expensing probably sounds like something that only matters to a CPA trying to balance a spreadsheet.
Usually it is.
Right. But I want you to break down the mechanics of why this matters, and then we will talk about what it reveals about the actual oil field.
Okay, so at its core, the decision to capitalize or expense an asset dictates exactly when the cost hits your profitability.
Okay.
So if you buy a heavy-duty pickup truck for your business, you don't expect it to become worthless in one single month, right?
Oh, of course not.
You expect it to last, say, 5 years. So accounting rules allow you to capitalize it. You put the truck on your balance sheet as an asset, and you slowly expense a portion of its cost, that's depreciation, over those 5 years.
So it smooths out the pain.
Exactly. It smooths out your earnings. If you had to expense a $100,000 truck in a single month, it would just destroy your profit for that month, even though you still have a perfectly good truck.
Makes sense.
Expensing, on the other hand, is for things you consume immediately, like printer paper or fuel.
Okay, so RPC used to treat their wireline cables like that truck. They bought these highly engineered, expensive armored cables, and they assumed they would last 18 months in the field. So they capitalized them and spread the cost out.
Exactly. But then they suddenly changed their mind. They literally told Wall Street, hey, we are no longer doing that. When we buy a cable, we are taking the entire financial hit immediately in that quarter on the income statement.
But why? Why would a company voluntarily choose to make their current quarter's profits look significantly worse by taking all that expense up front?
Because the physical reality out in the field changed.
How so?
Mike Schmidt, the CFO, explained that they aren't just, shuffling numbers around for fun. They're reacting to a major shift in how their customers are operating.
Okay.
The E&P companies are demanding much harsher, much more intense completion operations. Specifically, they are shifting heavily toward simul-frac and trimul-frac operations.
Okay, let's explain what that means, because that is the key to this whole mystery.
It really is.
In a traditional completion, a crew sits up on a well pad, runs the wireline down, perforates the rock, pumps the sand and water, and completes that single well stage by stage. It takes time.
Right, and out there, time is money.
Always.
So the industry evolved to something called zipper fracking, where they alternate between two parallel wells. While one is being pumped, the wireline is going down the other one.
Efficient.
Very. But simul-frac and trimul-frac, they take it to another level entirely.
Yeah, because simul-frac is literally fracturing two completely separate wells simultaneously at the exact same time.
Yep.
And trimul-frac is doing 3.
Which requires an unbelievable amount of pressure, fluid, and continuous operation. I mean, the operational tempo is just staggering.
The equipment doesn't get a break.
Rarely. It rarely gets to cool down. You are running these wireline cables down miles of steel casing into highly corrosive environments under extreme tension and pressure over and over and over again without a break.
And what does that do to the physical cable? I mean, it must destroy it.
It absolutely shreds it. Schmidt told the analysts that because of these brutal simul-frac and trimul-frac environments, RPC realized that their wireline cables were no longer lasting anywhere near 18 months.
Wow.
The useful life of the asset literally shrank in front of their eyes. The cables were wearing out and having to be discarded in less than a year.
I want to refine that truck analogy from earlier because it perfectly illustrates what's happening here.
Go for it.
For years, RPC treated these wireline cables like a family minivan, right? You buy a minivan, you expect it to commute back and forth to work for years. It's reliable, it's predictable.
Right.
You amortize the cost over a long period because the wear and tear is slow. But over the last year, their E&P customers essentially came in, took the keys to the minivan, and started using it for drag racing every single day.
That's exactly it.
They are redlining the engine, they are burning through the tires, and they are blowing the transmission in a matter of months. So RPC's accounting department looked at the reality in the field and basically said, we can't pretend this is a long-term asset anymore.
We are destroying these cables so fast that they are essentially a consumable supply, like fuel or sand. We just have to expense them up front.
That is wild.
It is a phenomenal way to visualize it, honestly. Management explicitly said they had to get ahead of the physical reality because, if they kept capitalizing cables that were already destroyed and thrown in the scrap heap, they would just be building up phantom assets on their balance sheet.
Which is terrible accounting.
It's terrible accounting. So they made the switch. It increased their cost of revenues, which, by the way, hit $337 million this quarter, and it reduced their capital expenditures.
Right.
But as Schmidt correctly pointed out, this is largely a geographical shift on the financial statements. It results in zero actual change to their free cash flow.
Because the cash goes out the door either way.
Exactly. The company had to spend the cash to buy the cable regardless. It's just a matter of whether it hits the income statement today or gets dragged out over the next 18 months.
Okay, so we have a picture of a company facing some pretty serious headwinds. They parked a massive pressure pumping fleet because pricing is terrible. Their wireline cables are getting incinerated by the brutal physics of simul-fracs.
Yeah.
And international markets drag down their tool division.
Sounds pretty bleak.
It does. If I stop right here, it sounds like a very bearish thesis. But reading through the transcript, there are some glaring bright spots that we absolutely have to highlight. Like, it wasn't all bad news.
Not at all. While pressure pumping dominates the headline revenue, RPC has several highly specialized, less capital-intensive service lines that performed incredibly well this quarter.
Okay, where are they winning?
Well, they're finding niches where they actually have pricing power.
Let's talk about CED Pressure Control, one of their subsidiaries. Their snubbing operations shot up 13% sequentially.
Yeah, that was a big jump.
But let's explain what snubbing is, because it is one of the more intense jobs in the oil field.
Snubbing is fascinating. Normally, when you are working on a well, you want it dead, meaning the pressure is controlled by heavy drilling mud so the oil and gas don't blow out of the hole.
Right, safety first.
But sometimes you need to intervene in a well that is live, meaning it has active, high pressure pushing up toward the surface.
That sounds terrifying.
It is. If you need to push pipe down into that live well, the pressure is actively fighting you, literally trying to spit the pipe back out.
Wow.
So snubbing is the highly specialized process of using massive hydraulic forces to literally force or snub the pipe down into the live well against extreme pressure, all while passing through a complex system of blowout preventers to ensure the well doesn't just erupt.
Man, it is high stakes, highly engineered work, and their revenue in this specific super dangerous niche jumped 13%.
Yep.
Why this sudden spike in demand for snubbing in Q4?
Well, management noted it was being driven heavily by regulatory requirements, specifically related to cavern gas storage work.
Okay, let's unpack that. Why is gas stored in caverns, and why are regulators suddenly caring about it?
Natural gas consumption is highly seasonal, right? We use vastly more of it in the winter for heating.
Okay.
But production from the wells is relatively steady year-round. So in the summer, excess natural gas is pumped underground into massive depleted salt caverns or old reservoirs for storage.
Okay.
Then when winter hits, they draw it back out. But because these caverns hold immense volumes of highly pressurized flammable gas near populated areas, regulators mandate really strict maintenance and integrity testing on the wells that access these caverns.
Oh, and you need a snubbing unit to go in and do that maintenance without depressurizing the entire massive cavern.
Exactly. RPC is leaning heavily into this niche. It's highly specialized, and the customers have to do it by law, which means they can't just defer the maintenance because gas prices happen to be low.
Oh, that's brilliant. It's sticky, reliable revenue.
Very sticky. In fact, RPC announced on this call that they are taking delivery of a brand new, highly specialized big bore snubbing unit in early 2026, specifically designed just to service this cavern gas storage work for a long-term customer.
Now that is the definition of a moat. You build a custom multi-million-dollar piece of equipment for a specific client to fulfill a federally mandated maintenance schedule.
Doesn't get much safer than that.
No, it doesn't. That is a guaranteed cash flow stream for years.
And the bright spots extend beyond just snubbing. Let's look back at the Through Tubing Solutions, or TTS division.
Okay, the one that was down 9%.
Right. Even though their total revenue was dragged down by the Middle East, their proprietary technology is actually gaining serious market share domestically.
I really want to dive into this tech because, in a commoditized market where everyone has trucks and pumps, intellectual property and better engineering are how you survive.
Absolutely.
The first one management highlighted is the A10 downhole motor.
Yeah, they rolled this out in late 2024. A downhole motor is essentially a localized engine at the very bottom of the drill string, right above the drill bit.
Okay.
So instead of rotating 3 miles of pipe all the way from the surface, you pump fluid down the pipe, which spins a rotor inside the downhole motor, which then turns the bit. It allows for incredibly precise directional drilling.
So why is the A10 special? Like, what exact problem does it solve for the E&Ps?
It solves the problem of lateral length. Wells aren't just going 2 miles deep anymore. They are going 2 miles deep and then turning completely sideways and going 3 or 4 miles horizontally through the shale.
That's insane.
It is. And pumping fluid that far and generating enough torque at the bit, it creates immense friction, heat, and pressure. Conventional motors just start to fail under those loads.
They just break down.
Right. The E&Ps need motors that can handle much higher flow rates without breaking down. And RPC claims the A10 provides unmatched performance in these extreme laterals.
And E&Ps are buying it.
E&Ps are starting to demand it by name, which is actively driving incremental market share gains for RPC.
Very cool. And the second piece of tech they highlighted is directly related to that motor endurance, right? It's called Metal Max.
Yeah. This is a materials science upgrade. The traditional power section of a downhole motor uses a metal rotor spinning inside a stator lined with an elastomer, which is basically a highly engineered rubber.
Okay, rubber stator.
But elastomers have physical limits. When you subject them to extreme heat, harsh drilling chemicals, and massive torque in a 3-mile lateral well, the rubber eventually chunks or tears or swells, and the motor fails.
And when it fails, you have to pull the entire drill string out of the hole to replace it, right?
Yep. Which costs the E&P hundreds of thousands of dollars in lost rig time.
Ouch. So Metal Max replaces the rubber with metal.
Exactly. It's a metal-on-metal power section. Now, it's significantly harder to engineer because you don't have the rubber to provide a forgiving seal.
Right, the tolerances must be crazy.
They are. But the benefits are massive. It allows for a much shorter motor design, it outputs higher torque, and most importantly, it drastically reduces downtime caused by elastomer failures.
Wow.
RPC started prototyping Metal Max in a few key basins, and the results were so dominant that they are now rapidly expanding it into other regions.
That is a game changer. Which brings us to the third piece of highlighted technology, a product called Unplugged.
Yeah, this one is interesting.
I have to admit, when I first read the transcript, this one blew my mind a little bit. But to explain why Unplugged is a big deal, we really have to explain how a modern well is completed using the plug-and-perf method.
Right. The plug-and-perf method is the industry standard. When you have a horizontal well that is 3 miles long, you can't just pump fracking fluid into the whole thing all at once.
It wouldn't work.
No, you have to isolate it into sections or stages. You pump the first stage at the very end of the well, then you run a wire line down and set a composite bridge plug to seal off that stage.
Okay, so you plug the hole.
Yep. You perforate the casing above the plug, frack the next stage, set another plug, and repeat. A modern well might have 50 or 60 of these bridge plugs sealing off different stages.
But the problem is, once you are done fracking, you can't actually produce the oil through 60 solid plugs in the pipe. You have to get them out.
Right, so they have to bring in a coiled tubing unit with a drill bit, and they literally spend days drilling out every single one of those composite plugs so the well can flow.
That sounds so tedious.
It is incredibly time-consuming, it's expensive, and sometimes the plugs get stuck, which causes massive delays.
Which is exactly where Unplugged comes in.
Yes.
Management described this as a technology that reduces, and sometimes completely eliminates, the need for these solid bridge plugs to achieve stage isolation.
Which is huge.
It is. Now, the transcript didn't dive into the exact proprietary physics of like whether they're using dynamic sand plugs or some alternative pressure diversion tactics, but the value proposition is incredibly clear.
The value is time. If an E&P doesn't have to set 60 solid plugs, they don't have to spend 3 days drilling them out at the end.
Right.
They can bring the well online faster, saving massive amounts of rig time and capital. Management noted that while Unplugged is still early in its life cycle, adoption is steadily increasing as operators realize the efficiency gains.
So if we synthesize everything we just talked about, RPC has the intellectual property, they have the A10 motors, Metal Max, and Unplugged. They have a dominant position in wireline.
Right.
But if we zoom back out to the macro picture, they are still voluntarily idling pressure pumping fleets because pricing is terrible and their E&P customers are still shredding their wireline cables.
Yeah, the tension is real.
The present is clearly strained, which begs the question, what does the executive suite actually expect for the future? How are they deploying their capital going forward? This brings us to management guidance.
Yeah, guidance is where the management team really has to put their money where their mouth is. It's one thing to say you have great technology. It's another to tell Wall Street what you actually expect to earn.
So let's start with the checkbook. Capital expenditures, or CapEx, for 2026 is projected to be between $150 million and $180 million.
Right.
For context for you listening, this is the money they are allocating to maintain their equipment, buy new pumps, and invest in tech. But there was a pretty big caveat mentioned on the call.
Right. They noted that this 150 to 180 million range is slightly inflated because about $15 million in planned spending from 2025 was delayed and pushed into early 2026.
And this triggered a very sharp question during the Q&A. Chuck Minervino, an analyst from Susquehanna, caught a potential discrepancy.
Oh, he really did.
He connected the CapEx guidance back to the accounting change we discussed earlier. He essentially asked, wait a minute, if you're now expensing wireline cables on the income statement instead of capitalizing them through CapEx, shouldn't your overall CapEx budget be significantly lower?
It was a great catch by the analyst, because if you pull millions of dollars of cable purchases out of the CapEx bucket and just put them in the OpEx bucket, the CapEx number should absolutely shrink.
Right. But CEO Ben Palmer's response was very telling about how they actually view budgets.
What did he say?
Well, he basically admitted that they're putting out a conservative, perhaps slightly larger guidance number than strictly necessary.
Under promise, over deliver.
That's exactly. He didn't want to overpromise a low capex number and then have to revise it upward later.
Right.
He emphasized that just because they budgeted $180 million doesn't mean they are actually committed to spending it.
Okay.
They scrutinize every single dollar of capital expenditure. If market conditions remain soft, there are absolutely opportunities to reduce that spend and hold on to the cash.
Okay, so they have a very tight leash on the checkbook. But what about actual operations in early 2026? Because they dropped a pretty heavy warning right out of the gate regarding the weather.
Oh, they definitely did.
Yeah.
Management explicitly warned that the first quarter of 2026 has already been significantly impacted by severe winter storms.
Specifically in the Permian Basin and the Mid-Continent region, which encompasses places like Oklahoma.
Right.
These are their two biggest hubs of activity. Now, for anyone who doesn't work out in the field, it's important to understand why cold weather is so devastating to an oil field services company.
It's not just snow days, right?
No, the infrastructure in West Texas is simply not built for hard freezes. It's not just that it's uncomfortable for the crews out there. The entire operation is dependent on fluids.
Right.
You are pumping millions of gallons of water. When it hard freezes in the Permian, the above-ground water transfer lines freeze solid. The chemical additives actually change viscosity.
Oh, wow.
The roads become impassable for trucks hauling 80,000 pounds of frac sand. The E&Ps literally have to shut down the well pads because the physical mechanics of pumping fluid just fail when the water turns to ice.
Right. And Don Kreist, an analyst from Johnson Rice, he pressed them on this. He asked if Q1 is going to shake out similarly to the weak fourth quarter simply because the weather is shutting everything down.
And Palmer was very blunt about it. He said they are still analyzing the total impact, but both the Permian and the Mid-Con were hit really hard by extended fuses.
Yeah.
But the most important thing, he said, the phrase that investors really need to pay attention to, was regarding the financial nature of these delays.
Right. They said that while activity will resume as conditions improve, the lost operating days from these storms are not fully recoverable, and the associated costs incurred will impact near-term profitability.
The phrase "not fully recoverable" is the killer there.
Yeah, that stood out to me.
If a factory loses power on a Tuesday, they can sometimes just run a double shift on Saturday to make up the production quota.
Right.
You cannot do that in pressure pumping. The schedules are already so tightly packed. If a frac crew sits idle for 3 days waiting for the ice to melt, you don't magically get to pump twice as much sand the next week to make up for it.
So that revenue's just gone forever.
It's gone.
But the costs aren't gone, are they?
Nope.
You still have to pay the day rates for your crews sitting in the hotels. You still have to pay the leases on the equipment. You still have to pay the logistics coordinators. The revenue drops to zero, but the expenses keep ticking.
It is a direct, unavoidable hit to the profit margins for the first quarter.
Which means Q1 is likely going to look really messy when they report it a few months from now.
Oh, absolutely.
Okay, let's unpack this overall strategy, because this is where I really want to push back on RPC's executive team.
I'm listening.
I am looking at this company from the perspective of a retail investor, right? I see a company that just reported a top-line revenue drop. I see them issuing a severe weather warning that is going to hurt Q1 margins.
Right.
I see them voluntarily parking a massive pressure pumping fleet because pricing is terrible. Their stock is languishing because the broader energy market is choppy.
That's a lot of bad news.
But I also look at their balance sheet, and their balance sheet is an absolute fortress.
It is arguably one of the strongest balance sheets in the entire OFS sector right now.
They ended the quarter sitting on $210 million in pure cash. They have zero debt. Zero. No long-term notes, no looming maturity walls.
Incredible.
And on top of the cash, they have an untouched $100 million revolving credit facility. So here is my question, and I really want to push on this.
Okay, go for it.
If their stock is cheap, which management implicitly believes it is, and they have a literal mountain of cash just sitting in treasuries earning maybe 4 or 5%, why are they just sitting on their hands?
It's a fair question.
Why aren't they executing massive, aggressive stock buybacks? Like, if you believe in your company and you have $210 million lying around, why wouldn't you buy your own shares at a discount and reward your loyal shareholders?
It is the most logical question to ask, and frankly, you aren't the only one asking it. An analyst from Johnson Rice, Don Christ, pressed Palmer on exactly this point. Yeah, he pointed to the cash hoard and asked point blank, are we going to see buybacks, or are you hoarding this cash for mergers and acquisitions?
And what was Palmer's defense for sitting on the cash instead of buying back the stock?
Palmer's answer was essentially, a buyback program is always in our tool chest, but do not expect us to use it in the near term.
But why?
To understand why they are refusing to buy back stock, you really have to understand the cyclical, highly destructive nature of the oilfield services industry. In this sector, cash isn't just an asset to optimize. Cash is oxygen.
Okay, but they have $210 million of oxygen, and they're just holding their breath.
Because they have survived previous down cycles, like the brutal crashes in 2014 and 2020. During a down cycle in OFS, leverage the death sentence.
Right.
Companies with debt covenants get forced into bankruptcy because their revenue drops, but their interest payments don't. RPC's management is profoundly conservative. They view that $210 million as an impenetrable shield against literally whatever the commodity markets throw at them over the next 2 years.
Okay, that explains the defensive posture, but it doesn't explain the lack of offense. What are they waiting for?
They are waiting for the perfect moment to deploy that cash into physical assets, not paper shares. Palmer made it crystal clear. They are guarding that cash for potential M&A mergers and acquisitions.
Which brings us back to the idled pressure pumping fleet. This seems to be the core philosophy of Ben Palmer's management style.
Exactly. John Daniel, an analyst from Daniel Energy Partners, asked what it would actually take to reactivate that parked equipment.
And what did Palmer say?
Palmer didn't blink. He said they are in zero panic to put it back to work. They refuse to accept weak pricing just to keep the machinery busy and juice the top-line revenue numbers for Wall Street.
Wow.
They demand a scenario with incrementally better pricing and, more importantly, a high probability of steady, sustained cash flow before they will turn those engines back on.
So they are actively choosing margin over market share. They would rather do less work for good money than more work for bad money.
Yes. And that exact same conservative, patient philosophy applies to their M&A strategy. They aren't doing stock buybacks because they believe that cash will be vastly more valuable when they find a distressed competitor they can buy for pennies on the dollar.
But I have to challenge that premise too. Is there actually anything left to buy?
Good question.
Because John Daniel pointed out in the Q&A that the universe of realistic buyers for traditional oilfield land equipment is shrinking rapidly.
Sure.
Some of RPC's major competitors are pivoting entirely away from traditional diesel pumping and moving toward electric fleets or power generation. Others were abandoning the U.S. land market to focus internationally. If everyone is leaving the space, who are they going to acquire?
Well, the fact that everyone is leaving the space is exactly why RPC is excited. Daniel's point is that it is fundamentally a buyer's market right now.
Oh, I see.
Palmer agreed entirely. There is very little competition right now from entities seeking to buy traditional OFS companies. Private equity has largely abandoned the space.
So because there are no competing buyers, RPC doesn't have to get dragged into aggressive bidding wars.
Precisely. They have the ultimate luxury in a cyclical industry, patience.
Right.
They can afford to sit back, let their competitors bleed out from low pricing, wait for a target whose business trajectory and valuation make perfect sense, and then strike with their $210 million in cash.
And Palmer mentioned they are widening their scope, right?
Okay.
They aren't just looking to buy more pressure pumping fleets.
Yes, they are actively looking at adjacent energy sectors. They specifically pointed to the success they are having with the cavern gas storage work in their snubbing division.
The sticky regulatory stuff.
Exactly. They like that regulatory-driven steady revenue. They indicated they are actively seeking M&A opportunities that could expand their footprint into those adjacent, less volatile edges of the energy sector.
Interesting. So if we pull all of this analysis together, we have a very distinct picture of RPC. Okay. We have a company basically battening down the hatches. They are proactively warning Wall Street about Q1 weather impacts. They are fiercely guarding a pristine $210 million cash pile. They are actively choosing to park equipment rather than work for cheap. And they are refusing to buy back stock so they can hunt for acquisitions in a buyer's market.
That's the lay of the land.
So what does this actually mean for you, the retail investor? What should you do with this information? This brings us to our final verdict on the stock.
We really need to synthesize the data, the guidance, and the macro environment here.
Based on the deep read of this earnings transcript, I am going to take a firm position on RPC.
Let's hear it.
For retail investors considering this stock, I am classifying the near-term outlook as short-term bearish, but the overall thesis as a long-term defensive hold.
I believe the physical realities of the market and the financial data entirely support that bifurcated position. Let's start with the actionable takeaway for the short-term bearish side.
If you are a momentum trader looking for a quick pop, if you want a stock that is going to surge 15% next week on explosive growth RPC, is absolutely not the place for your capital right now.
The catalysts for near-term upside simply do not exist in the current commodity environment. Q4 was undeniably soft. Revenue contracted across pressure pumping, wireline, and downhole tools.
The international and Rocky Mountain markets showed distinct weakness.
Right. And more importantly, management is actively throwing cold water on the upcoming quarter. Those severe winter freezes in the Permian and the Mid-Continent mean unrecoverable lost days.
Exactly.
The profitability in Q1 is going to take a hit, and they told us that plainly. Operationally, they are demonstrating massive restraint.
They parked a fleet in October and explicitly stated they will not reactivate it until returns improve.
Right. They are not chasing low-margin work just to keep the lights on. That intense capital discipline means the revenue is not going to magically explode in the next 90 days. It is going to remain constrained.
Which is why the short-term outlook is very bearish. But that leads directly into the second half of my verdict. The long-term defensive hold.
Okay, pitch the hold.
If you are a current shareholder, or if you are an investor looking for a place to park capital in the energy sector that carries a near zero risk of bankruptcy, you just have to respect this balance sheet.
In the oilfield services space, the balance sheet is literally the only truth that matters when the cycle turns downward.
Right. Leverage is what kills OFS companies. When you owe $50 million a year in interest payments and E&Ps stop fracking wells, you die.
You get wiped out.
But RPC has zero debt. Zero. They have a $210 million in cash. They have a $100 million credit facility they haven't even touched. A company with this capital structure does not go bankrupt during a down cycle.
They don't just survive it. They are mathematically positioned to thrive coming out of the other side.
And crucially, while you are waiting for this sluggish cycle to turn, RPC is actually paying you.
Right, the dividend.
They paid $8.8 million in dividends in Q4 alone and $35.1 million in dividends over the trailing year. You are literally getting paid to wait.
If we summarize Ben Palmer and Mike Schmidt's entire operational strategy from this transcript, it is an absolute masterclass in playing defense flawlessly.
Truly.
They are ruthlessly cutting phantom assets like recognizing the wireline cable burn rate and adjusting the accounting immediately to reflect reality.
Right.
They're investing heavily in high-margin, market-share-grabbing intellectual property like the A10 motor, Metal Max, and the Unplug system. And they are aggressively guarding their cash for the perfect M&A opportunity in a market totally devoid of competing buyers.
They are fully prepared to wait out the storm, and they have the financial armor to do it comfortably.
Exactly.
Which brings me to a final, pretty provocative thought I want to leave you, the listener, with today. We just spent an hour talking about how RPC is sitting back, refusing bad work, earning interest on a $210 million cash pile, and waiting for the market to improve.
Yeah.
But what is happening to everyone else? Like, what is happening to the rest of the OFS market?
The smaller players are suffering, really suffering.
Exactly. What happens to the highly leveraged, mid-tier, and mom-and-pop competitors?
It's ugly.
During the Q&A, an analyst specifically asked if RPC was seeing competitors reorganize or get absorbed. And Ben Palmer noted that yes, they are absolutely hearing that market stress is getting to the less well-capitalized companies.
The E&Ps are demanding brutal pricing, the equipment is wearing out, and the smaller guys just don't have the cash to replace it.
So here's the question you need to ponder as an investor. If these smaller, debt-burdened players get completely starved out by this prolonged period of low prices, what does the landscape look like when oil finally rallies?
That's the million-dollar question.
Will RPC emerge on the other side of this down cycle, not just as a survivor, but as an absolute apex predator? With limited buyers in the space, will they use that $210 million war chest to buy up the distressed assets and intellectual property of their bankrupt competitors at a massive discount?
It's very possible.
Could they secure a significantly larger slice of the market share just as prices finally turn upward?
It is the ultimate contrarian setup in cyclical investing. I mean, the messy earnings, the accounting noise, and the parked equipment we dissected today, it might just be the camouflage hiding a massive generational opportunity for the one company that can actually afford to wait it out.
Beautifully said. And that is going to do it for our breakdown of RPC's fourth quarter on the deep dive.
It was a fun one.
We hope this helped clear up the diagnostic muddy waters of the oil field, translate the accounting jargon, and highlight the actual physical mechanics driving the numbers. Thank you so much for tuning in. Remember to stay informed, always read past the headline numbers, and keep questioning the data. We'll see you on the next deep dive.